Silver is not trading at one global price anymore. That is the story. In Japan, buyers are paying around $130 an ounce. In Kuwait, they are paying about $106. In Korea, near $97. But on Western screens, silver still looks cheap at roughly $71. Same metal, same ounce, completely different reality. And that gap is not a glitch, it is a warning siren. Because once the world starts paying two different prices for the same hard asset, you are no longer looking at a healthy market. You are looking at a market split between paper fiction and physical truth. What makes this even more dangerous is how quiet the Western system has been about it. If this were a normal commodity market, every desk on Wall Street would be in full panic mode. Analysts would have to explain why buyers in Asia and the Middle East are accepting prices that are 30, 40, even 80% above the benchmark quote. But instead, the silence is deafening. And silence at a moment like this is not calm. Silence is cover. Silence is what happens when a pricing model is breaking in public, and the people who built that model do not want you to notice. Look at what this really means. If silver is supposedly worth $71, why are real buyers elsewhere paying far more to get it? Why are dealers, manufacturers, and private wealth buyers in multiple regions acting as if the Western quote does not reflect reality? There are only two possibilities. Either buyers in Japan, Kuwait, and Korea have all lost their minds at the same time, or the Western quote is no longer the real price of silver. And the deeper you go into this story, the more obvious the answer becomes. Think of it like this. Imagine a wholesaler tells you bricks cost 40 cents each. Great, cheap bricks, amazing deal. But when you show up with your truck, there are no bricks. There is only a quote. There is only a promise. There is only a contract saying that under the right conditions, someone might deliver something later. Then you go to a real yard with real inventory, and the owner says the actual price is 60 cents, because he has the product, the labor, the storage, and the delivery cost right there in front of you. Which number matters? The fantasy number from the guy with no bricks, or the real number from the guy who can actually load the truck? That is where silver is now. The Western spot price is increasingly behaving like the quote from the yard with no bricks. It is a price discovered inside a paper-heavy ecosystem where contracts trade, leverage multiplies, algorithms scalp, funds hedge, and almost no one asks for the bars. The physical prices in Asia and the Middle East are behaving like the real yard. Those numbers are formed by people who need the metal, want the metal, or refuse to settle for a promise in place of the metal. That is a completely different universe, and the spread between those two universes is widening. This is why the screen price can look calm while the physical market screams stress. On Western exchanges, silver moves through futures, forwards, options, swaps, rollovers, and synthetic exposure. Huge volume, tiny delivery, endless turnover. It looks deep, it looks sophisticated, it looks efficient. But the entire structure depends on something very fragile. Most participants never demanding the underlying product. The machine works as long as nearly everybody agrees to trade exposure instead of taking possession. The problem starts when more people decide they want bars, not spreadsheets. And that is exactly why what is happening in Japan, Kuwait, and Korea matters so much. These are not meaningless outliers. These are places where silver is tied to real behavior. Japan uses silver across advanced manufacturing, electronics, and industrial production. Korea sits inside a dense technology and battery supply chain where hard inputs matter. Kuwait and the wider Gulf region still understand something much of the modern West has forgotten. Precious metals are not just trading symbols. They are portable, stored value. They are something you hold when trust in systems starts to thin out. When buyers in those markets pay up, they are not making a casual lifestyle purchase. They are signaling urgency. Now step back and ask the uncomfortable question. If Western price discovery is still legitimate, why is the premium gap growing instead of closing? Under a clean, functional system, arbitrage should hammer this difference back into line. Traders should buy where silver is cheap, move it where silver is expensive, and capture the spread until the market converges. That is what textbooks tell you. That is what finance professors love to say. But what if the metal is not loose enough? What if the bars are not available in the right size, place, quantity, or timing to close the spread? What if the paper market is liquid, but the real market is tight? Then the arbitrage story starts to fail. And when arbitrage fails, it means the benchmark is losing contact with the thing it claims to benchmark. That is why this should not be dismissed as a quirky, regional premium story. Regional premiums happen. Temporary dislocations happen. But this is starting to look like something bigger. It looks like a fracture between price representation and physical access. It looks like the difference between owning a claim and owning the asset. It looks like the moment when the world begins to separate silver exposure from silver in hand. And once that separation gets wide enough, the benchmark stops being a global truth and becomes just another local opinion. 6 months ago, many people could still argue these premiums were noise, maybe a little shipping stress, maybe local taxes, maybe a temporary inventory issue. But when you begin seeing prices like $130 in Japan, $106 in Kuwait, and $97 in Korea while Western screens still pretend silver is near $71, the argument gets much harder. That is not noise. That is the market shouting that immediate, physical, deliverable silver is worth materially more than the official benchmark suggests. And if that keeps happening, one of the two worlds has to move. Either the West reprices upward, or the Western quote becomes increasingly irrelevant. Now we get to the part almost nobody wants to say out loud. A benchmark can survive being imperfect. It cannot survive being ignored. The real danger for the Western paper price is not only that it might be wrong. The real danger is that global buyers may eventually stop caring whether it is wrong. Once manufacturers, dealers, and wholesale buyers begin negotiating off regional physical prices instead of COMEX or London Spot, the old benchmark starts to decay from the inside. It still exists. It still prints. It still flashes on television. But it no longer governs the actual transfer of metal. It becomes theater. And history is full of systems that looked powerful right until the moment the real economy routed around them. That is the risk here. Not merely a spike in volatility, not merely a short squeeze, a credibility problem, a slow-motion loss of authority. The benchmark still says silver is cheap. The rest of the world starts acting like silver is scarce. For a while, both stories can exist side by side. Then one day they cannot. And when that day arrives, the adjustment is usually violent because the lie had time to accumulate. Now think like an industrial buyer for a moment. If you run a factory and need silver for actual production, the quoted price on a Western terminal is not your cost. Your cost is whatever you must pay to secure delivered metal on time, in spec, in size, with no excuses. If that price is $97 or $106 or $130, then that is the real price in your world. The paper quote does not help you ship finished goods. It does not help you meet contracts. It does not help you keep a production line running. Physical supply does. That is why physical price eventually wins. It is anchored to function. Paper price is anchored to confidence. Function survives longer than confidence. And if you are a bullion buyer, the story is just as blunt. A dealer does not replenish inventory at the fantasy quote. A dealer replenishes at the actual replacement cost. If replacement cost rises while spot lags, retail buyers in the West may still think they are getting a bargain, but that only lasts until inventories thin, premiums widen, and delivery times stretch. Then the cheap quote on the screen starts to feel like a cruel joke. You are told silver is one price, yet the metal in the real world keeps demanding another. This is how financialized benchmarks begin to crack. First, people notice a weird spread and assume it will close. Then the spread persists. Then it widens. Then the physical market starts treating the benchmark as optional. Then the benchmark becomes a settlement reference for leveraged traders, rather than a truthful signal to the world. We may be much closer to that stage than most people realize. And if that is true, the implications go far beyond silver. Because silver is one of those metals that sits at the crossroads of money, industry, technology, and trust. A pricing break here tells you something important about the broader system. It tells you the West may have overestimated how long paper structures can dominate real scarcity. It tells you that regions with stronger physical demand are beginning to assert their own reality. It tells you that the old assumption that a benchmark is real simply because it is established may be dying. And it tells you that people who wait for mainstream confirmation will almost certainly arrive late, because mainstream confirmation usually comes after the move, not before it. So what happens next? There are only a few paths, and none of them are casual. Path 1. Western prices finally catch up. Physical pressure keeps building, confidence in the paper quote weakens, and silver reprices sharply higher as the benchmark rushes toward the levels already being paid in parts of Asia and the Middle East. Path 2. Western paper markets keep printing a lower number for a while, but actual physical metal in the West becomes harder to source near that number, forcing premiums higher until real buyers are effectively paying the global physical price anyway. Path 3. The benchmark loses international authority altogether, and regional physical hubs become the only prices that matter. But notice what all three paths have in common. None of them end with the current spread sitting here forever like it is normal. This setup is unstable by definition. When the same ounce trades at two radically different prices, the system is broadcasting imbalance. An imbalance of this size does not resolve by magic. It resolves through repricing, shortage, irrelevance, or all three. That is why this is not a story for someday. It is already underway. The market is not hiding the evidence. The evidence is right there in the premiums, right there in the replacement costs, right there in the behavior of buyers who are choosing metal over promises. The average person checks a phone, sees $71 silver, shrugs, and thinks the story ends there. It does not. That number may be the least important silver number on the planet if your goal is to understand what real demand is willing to pay for real ounces right now. And this is happening against a backdrop that makes the whole picture even harder to ignore. China has already moved to restrict silver exports. Large pools of capital in the banking system have been yanking liquidity heavily. That does not automatically prove a single cause, but it does tell you something critical. Stress is building in the plumbing, while physical demand is pressing on the other side. Tight supply, fragile confidence, rising premiums, and a benchmark that still refuses to tell the whole truth. That combination is not stable. It is combustible. This is also why the next phase can become psychological warfare as much as financial adjustment. The screen can still be used to create calm. Downdrafts can shake weak hands. Headlines can still be framed to make the move look temporary, irrational, emotional, or niche. But none of that changes what buyers in real markets are already doing. If physical silver keeps leaving shelves, crossing borders, entering vaults, and disappearing into industrial channels at higher and higher prices, then narrative management cannot fix the underlying problem. It can only delay public recognition of that problem. And delays matter, because delays are how big repricings get built. Every extra week that a false anchor remains on the screen allows more people to underestimate the seriousness of the shortage. Every extra month that the benchmark lags replacement cost encourages the wrong behavior. Buyers wait, traders dismiss, commentators downplay. Then suddenly the catch-up move arrives, and the same people who ignored the evidence rush to explain why nobody could have seen it coming. But the evidence is here. It is not hidden. It is only being ignored because accepting it would force a much bigger conversation about how commodities have been priced, who really controls the benchmark, and what happens when the real economy no longer accepts the answer. That is where opportunity and danger sit side by side. The opportunity is obvious. If you are in a region where silver can still be obtained closer to the Western benchmark than to the Asian physical price, you are staring at a rare disconnect. The danger is just as obvious. Disconnects like this do not ring a bell before they close. They do not send a polite email saying your window expires Friday. They stay open longer than expected, then move faster than expected. That is how all major pricing illusions end. Slowly, then suddenly. Ask yourself something. If Japan is paying $130, Kuwait is paying $106, and Korea is paying $97, what exactly are Western buyers waiting for? Permission? Television coverage? A central bank memo? By the time everyone agrees the physical price is the real one, the advantage is gone. By then the cheap quote was already history. By then the market already chose. And this is why the most valuable information often feels uncomfortable when you first hear it. It forces you to admit the official number may not be the true number. This is not a call for panic. It is a call for clarity. Clarity says a hard asset with visible global premium divergence is sending a message. Clarity says paper convenience and physical necessity are no longer aligned. Clarity says the market structure people trusted for years may be less durable than advertised. And clarity says ignoring those signals because they are inconvenient is exactly how people get blindsided. One more thing matters here, and it matters a lot. Once a benchmark loses trust, restoring that trust is extremely difficult. You can defend a price, you can massage headlines, you can point to liquidity, you can call critics emotional or conspiratorial or uninformed. But if actual buyers keep paying far more for actual metal, eventually reality becomes too expensive to hide. The screen says one thing, the invoice says another, the vault says another. The replacement order says another. At some point, the screen is the outlier. So here is the bottom line. Silver is no longer telling one story, it is telling two. The paper story says everything is under control, price is orderly, and the benchmark still rules. The physical story says deliverable ounces are worth much more, and the regions closest to real use and real demand are already paying up. Those two stories cannot coexist forever. One will absorb the other, and when it happens, people who spent months staring at a misleading quote will say the move came out of nowhere. It will not have come out of nowhere. It is announcing itself right now. The West is still staring at the screen. Japan, Kuwait, and Korea are staring at the metal. That is the difference. One side is watching a symbol, the other side is paying a premium for reality. And in every market, eventually, reality wins. So watch this carefully. Watch the premiums. Watch replacement costs. Watch whether physical supply gets tighter while the paper quote pretends nothing is wrong. Because that is where the truth will keep leaking out first. And tell me this. Do you think Western silver prices finally snap upward to meet the physical market? Or do you think the paper benchmark simply loses its grip completely? And second, if the same ounce already costs dramatically more in key physical markets, how long do you really think the old price can survive? If this breakdown keeps accelerating, the next move in silver will not just be a price move, it will be a credibility event. And those are the moments that change markets for years. Subscribe and stay close, because this story is not cooling down. It is heating up. And the people still trusting the paper number may be the last to understand what the world already figured out.